And now it's time to welcome our first guest, Peter Lazaroff, the co-chief investment officer of the wealth management firm PlanCore. He's the author of Making Money Simple, the complete guide to getting your financial house in order and keeping it that way forever. Peter's also nationally recognized as a speaker, and he's a regular contributor to the Wall Street Journal and to Forbes. Peter, thanks for being on the show today.
Well, David, thanks for having me.
Now, we spoke off air just a little bit, and I know you said that 99% of the time you don't utilize alternatives. They're not bad, but most of the time, traditional investments serve an average investor better. But you said, in that 1 or 2% where you do use alternatives, you find that they fall into two categories. People are trying to achieve two different goals. Tell us about those, please.
Well, so I think for a very small segment, and particularly it's PlanCorp's family office where we have more alternative exposure. PlanCorp manages a little over $4 billion in assets, but the family office are people with net worths typically in the 100 million or above category. And I think if you are going into alternatives, the most important thing is to understand why you are doing it. And I think a lot of people go into it because they think expected returns on a stock bond portfolio are going to be lower. That's fine. I think there's a segment more private investment, so private credit strategies, private real estate, private equity, some hedge fund strategies that are more likely to be return enhancers. Whereas if the goal is, hey, I want to increase my diversification and lower the overall volatility of the portfolio, well, that might be a different segment of alternatives. And you are really just looking for assets that are lowly correlated to your existing set of investments.
Now, you'd said that at one point that the best portfolio is one that you can stick with. And oftentimes it's difficult to stick with alternatives for the long term. Why is that?
Well, I think what is challenging is that the expectations for alternatives going in are not always set correctly. And so it's difficult to stick with something that is lowly correlated to stocks and bonds, because if stocks are up and this alternative asset isn't really up as much, then you're a little disappointed. And then stocks are down, and well, gosh, what if that asset is also down? Then you think, why do I own this? And they're a little more complicated. They're a little more complex, and it's easy to ditch something that you don't understand. And so while, again, I'll reemphasize, there's nothing inherently wrong with alternative investments. I just think that truly understanding what you own and understanding the philosophy behind it is really what holds it all together when it appears to be falling apart. When it appears to, performance will make you think that something is broken, but really if you have a true understanding, then you might realize, oh, well, this is actually what I signed up for and it is doing its purpose. For me, I'm more concerned about implementing a bad idea than missing out on a good one. And as a result, I think that kind of drives the philosophy.
What do you mean by that? Explain that, please.
Oh, it's a good question. So, there's a lot of great strategies out there where the research shows that will improve returns. If I'm not as concerned about if I'm concerned about implementing a bad idea, it means that the bar for adding an additional strategy is very high, because I know that there's a diminishing marginal benefit to each additional strategy I add to the portfolio. The more and more strategies you add, you're not really improving the end result over the portfolio that much. If the bar is really high for inclusion, then we'll probably miss out on a couple good ideas along the way. If the bar is really low, then you're going to implement a lot of things that ultimately don't improve the portfolio. And it's really no different than the way, say, like the FDA approves drugs. They'll try to approve drugs that have minimal bad side effects and where the benefits to the public outweigh those bad side effects. But in doing that, they sometimes fail to approve drugs that ultimately help. They worry about the side effects, but you have to have that trade-off. In statistics, it's actually called type 1 and type 2 error, but we won't go quite there. But generally speaking, I think...
Bottom line is it's the unconscious mind, right? If you're more focused on preventing losses than you are focused on getting gains, well, your unconscious mind is going to attract more losses, and that's what you don't want. So it makes sense to me. We need to leave it there for this segment. We'll be right back in a minute. Stay with us. We'll be right back after the commercial break. I'm David Scranton, and you're watching The Income Generation. We'll be right back. And now it's time to welcome back Peter Lazaroff, the co-chief investment officer of the wealth management firm PlanCore, and also the author of the book, making money simple. So Peter, let's talk about making money simple. You say in the book that, or the purpose of the book, I should say, is to give people guidance on how to put their financial houses in order and how to keep it that way forever. Can you please share some of those tips with our income generation members on how to do that?
Sure. Well, let me start by saying that financial success is not magic. It's really just a matter of engineering. And so I think the most important thing is being intentional and creating systems that will allow you to make good decisions with very little effort and ongoing effort. Make it really easy to do the right thing over and over and over again. For investments, I think the more automation that you can build into your investment plan, the better. And automation doesn't have to just mean technology. The definition of automation is to operate independently. So if you hire an advisor, you are in many ways automating your finances. But I do think using technological automation or human automation is a big benefit. One of the things that I realized in writing the book was it also is really hard to decide, well, there's all these different decisions. Where do I start? And so in Making Money Simple, the goal is to focus just on a few important decisions so that you don't get overwhelmed by the many different choices. And then I also developed something called smartmoneyquiz.com to also do that, where you just answer 8 or 9 questions and it kind of directs you as to where to go and what are next steps. When you read the book, though, you kind of could do the whole thing yourself. It's designed to give you everything you need to manage your own money. I think what people tend to find, though, is, hey, I'm really busy, or there's this one piece I don't really know how to do, and then the book concludes with how do you find someone who could help you that's perfect for your needs.
Yeah, it's interesting. You use the word framework, I believe, in the book, where you say you don't really need to be an expert to achieve financial freedom. What you need is a framework that makes the right choices simple and easy to make. So can you explain that to our income generation viewers in the 1 minute we have left in the segment?
So I think the framework that's most important from the book is that of the goal setting framework and backing into the types of savings decisions you need to make, and then just living life easily from there. Because if you know where you're trying to go and you know where you are, you can set up automatic deposits for specific goals, and some of those will be invested, some of them will be not. But then you don't have to worry about it anymore, and you can eat out, or you can go to the grocery store, you can go to a concert or a sporting event, knowing that you are on track for the things that you have carefully sat down and prioritized, either on your own or with a significant other.
Mm-hmm. So basically, take the human error element out of it, take the emotions out of it, and just use this framework, whether it's computer-based or not, to keep you on track. Makes sense.
Yeah, a good system acknowledges that you can't take the human nature out of humans, but you can certainly work around it. And I think that that's really important. We're not designed genetically to be good investors, to make good financial decisions. Once you have a system that acknowledges that, it makes it a lot easier to be successful.
Yep. It's a learned thing. You need a system. Absolutely. Peter, thanks so much for being on the show today. We really appreciate it.
Thank you,
Stay
David.
with us. We'll be back here with more on the income generation. I'm David Scranton, and we'll be right back.